Yeah, today I wanted to talk about market regimes or just kind of introduce them. This is a concept that I'm personally extremely interested in. It is, like when we get into it, this is an introductory piece, but when we get into the methods a little bit more, these are kind of advanced topics, but it's got, I think, a lot of practical applications for traders, which is why I'm especially interested in them. I use regime models in like some of my own trading. And I think overall it's a really cool concept, which is why I just wanted to, at the very least, introduce it here. And then maybe in the next couple of segments, talk about some of these models a little bit more. Okay, so it is pretty widely accepted that the market actually transitions between different regimes. And when we say regime, these are sort of unique states that tend to propagate for a sustained period of time. We'll get into that definition a little bit more, but it's pretty accepted by academics, by financial professionals, that the market can kind of shift between these different states. And identifying these regimes is a pretty important part of especially active trading because we want to be able to adapt quickly these strategies to new market conditions. For maybe long-term investing, doing this regime analysis is a little bit less relevant. But if you're an active trader and you're trying to develop strategies that are appropriate for the market, actually being able to classify what kind of state the market's in is a pretty important part of that. So the goal of this presentation is to introduce this concept of market regimes and discuss common indicators of a regime transition. So market regimes are typically characterized by unique volatility, price, and macroeconomic conditions. And the transitions between these regimes are typically initiated by shocks to the broader market. And anybody who's been trading for a while now, for a couple of years, has probably traded through a bunch of these and can completely and knows how to recognize that maybe the market has moved into a different state that's defined by different specific conditions compared to other states. So some examples of regimes, to use sort of layman terminology, would be like a bull market is a type of market regime. And we recognize that bull markets tend to exist right for a sustained period of time. They're marked by specific volatility conditions, specific economic conditions. And this bull market can be sort of initiated, this regime can be initiated by any number of sort of shocks, right? Such as an interest rate cut, fiscal stimulus, any kind of that can sort of push this market into a new regime called bull market. Likewise, with the bear market, interest rate hikes or geopolitical crises might push us into a bear market, which is, again, this type of regime that can exist for a sustained period of time. And then when we talk about crash, which are these high volatility market periods that are typically marked by very significant moves to the downside with a slower recovery to the upside over time, those are obviously very, very rare and initiated by very unique circumstances. So like the Great Depression, Black Monday, the 2008 housing crisis, the COVID crash, all of those are like straight up crashes. And each time these were initiated by very, very specific events that impacted the market as a whole to cause this sort of market-wide volatility. So market regimes, that's this idea, they tend to exist for a sustained period of time, but the duration and the stability of those regimes tends to vary pretty notably as they are driven by sort of unique circumstances. There's also no universally accepted number of regimes, but it's generally recognized that there's somewhere between 2 and 4. And the exact number that you would use really depends on the type of analysis that you're trying to perform. So, for example, if you use 4 or even 5 market regimes, that might, if you're trying to identify 4 or 5 different possible types of market regimes, that might give you a little bit more granularity about what regimes can exist and what the specific characteristics might be exhibited in one of those 4 or 5 regimes. But what that means is you can also increase the risk of overfitting, which means that if I'm trying to find strategies that perform particularly well in certain regimes, and there are 4 different regimes, I might make a strategy that's a little bit too specific to the back-tested data that doesn't work very well in future regimes. And when you have more regimes, you kind of run the risk of overfitting a little bit more compared to fewer regimes. If there's only 2, for example, when you're trying to develop your strategies, when you're trying to detect different types of regimes, there's only 2. That's a much simpler model. It might give you less granularity in terms of the specific characteristics of each regime type, but it might help you to make a more generalized strategy that kind of works well with a smaller number of sort of market environments. I wanted to talk about sort of common techniques for identifying regime shifts. And so detecting a regime shift in real time is actually pretty difficult to do. I even remember back in 2020, when the market was crashing, crashed by like 30% in a month. And I remember the first couple of days when the market was crashing, everyone in the office was like, I can't tell if we're in a crash yet. I don't know yet, because like just one big down day doesn't mean you're in a crash, right? So the process of actually detecting regimes is a really interesting problem. And we're going to kind of maybe talk about those in future segments. But I wanted to kind of focus on the more intuitive indicators, I guess, specifically when the market transitions into a high volatility regime, because those are obviously, they're a little bit easier to spot compared to a bull market, compared to something more like a correction, for example, or a bear market. So when it comes to shifting into a high volatility regime, which are usually marked by like sell-offs, so for example, here, this is SPY from 2000 to present. And what I have marked with these red dots are days when the market dropped or moved, not even dropped, by 3.7%. When the market moved up or down by 3.7%. That is a big move for the S&P. The S&P very, very rarely moves that much. This is actually a 3 standard deviation move. So it's very, very large move. But what you actually notice is that when the market has one of these moves, they tend to cluster together, actually. They're not evenly separated, over time. What we see is that when it has a very large move like this, they tend to be concentrated in really short time periods. So when you have these frequent large moves over the span of weeks, over the span of days, over the span of months, in a broad index like the S&P, then that's what we call volatility clustering. That tends to be indicative that the market has shifted into a different regime, and specifically a high volatility regime. And like, we would use a market index for this, because like if Tesla has a 3 sigma move, like that could happen because of earnings, that could happen because of a tweet. But when something diversified like an index, that's kind of a proxy for sort of the US economy, the market as a whole, when it has a big move like that, what we see statistically is those moves tend to be concentrated, kind of clustered together, and exist in very, very, very short time frames. And those tend to be indicative of the markets kind of flying off the handle. So that's, I think, a pretty good indicator of maybe adopting a more defensive approach, if that makes sense, to your investing. These big moves in a broad index like the S&P typically indicator that we have shifted into a different regime. Although, as Louise pointed out, we might have one-offs, but they're just pretty rare. And we also see pretty significant shifts in intraday volatility. So when we look at, this is the percent change from open to close, right? From 2000 to present. And what we can see is that around 2000, around 2008, around 2020, we had way more intraday volatility, as well as the bear market of 2022. We had way more intraday volatility than we had, for example, from 2012 to 2016. That can be another indicator that, right, we've moved into one of these different regimes that are marked by different volatility conditions. The market's literally in a different state, like it's a different beast completely. And this is one of those indicators that we can kind of use to gauge that. And then as well, one number that kind of tells you a lot. This is a whole lot of information. We use it all the time. The VIX levels are also another proxy. That being said, so the VIX and historical volatility are fundamentally different, right? Because the VIX kind of measures investor fear, right? And investors might not get fearful very quickly, or they might overreact. This is kind of a measure of perception, but it can be very, very useful as kind of a gauge as to whether or not we've transitioned into one of these high volatility regimes. The VIX is between 0 and 20 about 60% of the time. So the 20 is around the long-term average of the VIX. Right now we're at 13. It's below average 60% of the time. Between 20 and 30, around 29% of the time. So we saw it back in August, right? It spiked up to 30, right? That happens about 30% of the time. It's between 30 and 40 about 7% of the time, and it's over 43% of the time. If the VIX is over 40, that usually means that shit's kind of hitting the fan a little bit, especially if it's sustained over 40. If it's 40 one day, if it's 45 the next day, if it's 48 the next day. Having a VIX over 40 for a number of different days is extremely rare, and that only typically happens when we have one of these very large sell-offs, large crashes. And it's nice because it's a one number value that kind of tells you sort of how investors are perceiving the market right now. If this doesn't sell diversification, I don't know what does. But so what we see here, this is the S&P, right? The price of it during the COVID crash. So during, from February to April of 2020, we're seeing the market sell off really steeply. What this dynamic table is showing you is the correlation between SPY and then all of these different sectors. So we have XLK is the tech sector ETF. We have XLV is the healthcare sector ETF, XOP, XLE for energy, XLF for financials, XLU for utilities. And what we see is that before the market crashed, The volatilities, I mean, some of these, right, the tech and the S&P, for example, had pretty high correlation. But when the market crashes like that, the correlation between most of these different market sectors becomes way more correlated. It becomes way, way, way stronger. And we don't see that everywhere. Like gold, for example, tends to develop an inverse correlation with the market, bonds as well. But a lot of I'd say most of the broader market, most of those sectors become much, much, much more correlated to the market when the market undergoes this period of turbulence. So this can be kind of another indicator that the market has moved into a different regime when we see the broad market these different sectors start to become more correlated to the broad market. And this is part of why diversification is so important, because when everything becomes more correlated to the market, especially if you're trading more sensitive assets like options are leveraged, right? So during these types of events, even though they're so incredibly rare, can be can be devastating when you're trading a leveraged instrument. And this is, again, part of why diversification is just so important. It's because when the market really moves, everything kind of moves with it. We see price correlations become stronger, and we also see volatility correlations become stronger. So if you're trading volatility and you're very sensitive to changes in volatility, that's part of why this diversification and sizing is so important. But to just kind of talk about what this sort of means as a trader, this is, again, kind of like broadly talking about regimes and what that sort of means as a trader. When it comes to actually using this for developing strategies as a quantitative trader, right? When it comes to predicting transitions between regimes or predicting the characteristics of a current regime. So for example, like how long is the regime going to last? How long is this bull market going to last? How long is this bear market going to last? That's pretty dicey. It's interesting area of academic research looking at some of the models that are trying to predict these phase transitions, these transitions between regimes, but it's generally unreliable for active trading. Predicting the market in general is just generally not reliable. There are some fairly reliable methods for detecting regime shifts in real time. So we talked about some examples of like how you can detect, like, right, if you can intuitively detect that the market has moved into a high volatility regime. But there are models that you can use for just kind of more broad regime detection. We talked about there are somewhere between like 2 and 4, 2 and 5 possible market regimes, right? So identifying those, there's actually some pretty interesting models that you can use to do that, as well as detect, shifts in real time a little bit more reliably. A lot of these are based in machine learning. These are ones that I'm really interested in. I want to make some more segments about them in the future. But one is these are clustering algorithms. So these are unsupervised machine learning methods. But what they basically do, these are a class of algorithms that will like sort of classify subsets of data into clusters that have the most similarity to one another, right? Which it's a very cool technique. Excited to talk about it. But basically, you just kind of give it some data, and it identifies data into groups based on similarity. So if you're trying to identify market regimes, and you assume that each regime, if there's 3 to 4, 4 to 5, whatever, if you assume that those regimes have similar characteristics, then this unsupervised learning method is one way that you can maybe group them together in a computationally reliable way. You also have hidden Markov models. Hidden ones are typically what you would apply to regime detection. But this is a type of model that's also used in machine learning that sort of identifies patterns in sequential data and transitions between hidden states. So if we assume like high volatility and low volatility are 2 possible market states, then what Markov models can do is basically detect which state the market is currently in, most likely, depending on, based on previous classifications. So Markov models, I think, are especially useful for this task because they're designed for sequential data. So, right, obviously the market is a sequential time series, right? Each day the market is evolving in time. And so if you're trying to identify where is the market now, and where has it been? And if I'm trying to look for trends in the sequence of data that I'm getting, which is the price of the market, this is where hidden Markov models, I think, are a really useful tool. But the third that we have are Gaussian mixture models, which are another method that's commonly used in unsupervised machine learning. But basically, we're trying to take this grouping of data, so grouping of SPY returns, SPY prices, whatever, and then model that data as a mixture of several different unique Gaussian distributions or normal distributions, right? So
Yeah.
we usually look at like returns and we use one distribution to represent that. But this model instead looks at those returns data as a combination of several Gaussian normal distributions, right? They're going to mean the same thing here. So if we treat instead data as like this data as a mixture of different Gaussian normal distributions, and each distribution has its own unique properties, then this is another way that we can kind of computationally do regime detection. You know, as a quantitative trader myself, I think this is like a really interesting way of just viewing the market. Even as a trader who doesn't necessarily use these more complex models, I think it's really important for active traders to kind of recognize that the market, when we say it fundamentally changes day by day, we're not fucking kidding. Like the market could be a completely different beast in 2008 or 2020 than it is today. Just to kind of do some takeaways, we introduce market regimes. They're typically characterized by unique, unique conditions, unique characteristics, volatility, price, and macroeconomic conditions. And transitions between these regimes are typically initiated by shocks to the broader market. And transitions to high volatility regimes are arguably the easiest to spot, although, I mean, obviously there's methods for doing that a bit more rigorously, but they can be kind of intuitively determined, right? Such as increases in price volatility in the broad industries, elevated VIX levels, and increased sector correlation with the market. And so while predicting regime transitions is precarious, or the length of these regimes, predicting anything in the market in general is precarious. There are fairly reliable methods for actually detecting these transitions in real time, which for, again, quantitative traders, for people conducting back tests, and I think for everybody, can be really helpful. And I also wanted to show one more thing. But I wanted to kind of talk, because I talked last week about sharing some tools for people who are interested in doing risk parity portfolio analysis, or what do you call it? Efficient frontier analysis. So I found this website. It's called Portfolio Visualizer. I just dropped the link over in chat. I'm going to go ahead and star this real quick. It's called Portfolio Visualizer. I talked, last week about sharing some online tools. This is the one that I was going to show before I decided to pivot the segment. But this is a site where you can basically do a bunch of different types of portfolio optimizations. So, for example, you put in your tickers. We're going to do 1985 to 2024. They have a couple different optimization methods. I don't know if you're able to see that, but I can pick I don't know if you're able to see the menu, but you can pick like risk parity, for example. So risk parity is the one that I just picked. I can pick, you can minimize or you can do like a mean variance, maximize the Sharpe ratio optimization method. So I shared the link over there if you want to mess around with it. You can let's do risk parity, for example. So if we do the risk parity portfolio, I just selected use historical returns, capital allocation, benchmark none. I'm going to pick, so let's say that the tickers that I want to use I want to have trade shares of SPY. I think this was from the example, very simple example, but let's do SPY, let's do QQQ, let's do IWM, let's do GLD,
TLT.
let's do Apple.
Let's
do Apple. Let's do TLT2. Let's do TLT. So this, again, very simple portfolio, but just to show what it's doing, you click submit, and then it calculates those risk parity weights, right? So these are the risk parity weights that we were talking about last week, but it's a cool tool that kind of does that. And you can see this will complete back tests. You can track the portfolio growth, compare it against a benchmark. It shows you annualized returns for different years. You can do also efficient frontier analysis in here. Promised I'd share that tool, so I wanted to go ahead and do that. But otherwise, guys, I think we are sharing that right now over on Bad Trader. Thank you guys for hanging out and kind of chugging along.